Okay, current liabilities and payroll. Last time we covered the current liabilities, but let's quickly go over the current liabilities again. Liability, what's a liability? Why liability by the definition is current obligation. Currently, the company owes somebody or have to transfer resources or money to third party because something happened in the past. Why we have the liability? Because at the time of the purchase, we didn't pay cash. If we have paid cash, there will be no liability. If we settle our obligation at the time of the purchase, there will be no liability. But because that doesn't happen, that's why we have liability. Now we have how many liabilities we have? In general, we have two sections, current liability and long-term liability. For the long-term liability, definition is easy. Everything which is not current liability is long-term liability. So that means we have to define what the current liability is. Current liability is obligation to the company, which is due within 1 year or company operating cycle. And then we have to see which one is longer. So the longer one prevails. If 1 year is longer than the current operating cycle, 1 year is this. If the current operating cycle is longer than 1 year, then the current operating cycle is. For the liability, we have accounts payable. Those are any purchases of inventory or materials which we're not paying at the time of the purchase. And usually we're paying within 30 days. Some company procrastinating and make 30 days up to 3 years. But that's still current liability, still accounts payable. Short-term notes payable is another form of liability. Short-term note payable is when we need the resources, when we borrow on the short term. This is one thing, but in this case, we're not borrowing, we're just paying for the inventory, signing the short-term notes payable. Usually we're using the note payable as a promise to pay something when we borrow the money. But in this case, we're going to use it as a promise that we're going to pay when we're purchasing assets. In this case, inventory. So at the time of the purchase, we're going to get the inventory and we're going to credit current liability with that note payable short term. Now, if we have reporting period, before the payment date, we have to accrue the interest on the note payable. And we have to show the interest expense and interest payable. Which interest payable we're going to pay at the payment date, and we're going to close at the payment date. At the payment date also, we're going to pay the interest, the remaining of the interest, the note payable itself, and we're going to close debit note payable for the short term for the amount of the note payable. We're going to close the interest payable, which is related to the interest payable that we accrue at the reporting date. And we're going to show the rest of the interest expenses to add the interest expenses for the entire period. And we're going to create cash. Why do we have to do this? Because we want to have match between expenses and the period. So if the expense is related to the 2022, we want to record that expense in 2022, not in 2023. The fact that we don't paying the liability, it doesn't change the fact that we owe the money. And for that reason, if you want them owe the money, we have to show associated expenses which are related to the amount of money that we owe at the reporting date. Also, we have to show the users of the financial statements that we have obligation to pay something in the future. For that reason, on the reporting date, which in this company is December 31st, they have to show interest expense and interest payable for the period on the note payable, which already expired up to the reporting date. So, what else we have as a short-term liability? We have a bank loan, short-term bank loan, and line of credit. Short-term bank loan, that's similar to the short-term note payable, which has fixed period, fixed principal, and negotiated interest rate. Line of credit is another thing that you can be arranged with financial institution. Financial institution is going to give you access to certain amount of money, which has a upper limit. And if you need money, you can borrow those up to that upper limit. But of course, you have to pay interest for the time that you're using the money and for the principal that you're taking from that amount. Next, short-term payable or liability is the GST, which we owe to the government. Now, on the GST, goods, service, harmonized taxes, and sales taxes, as you can see, we have the provincial taxes and we have federal taxes. Now, the GST is federal tax, 5% across Canada, where the provincial sales tax is given authority to province to choose how much they want to charge their residents as a sales tax. If the province likes their residents very much, they can give them a very nice high percentage. If they don't like them so much, they can give them zero. Depends on the province. Personal preferences on the province. And we also have a harmonized tax in some of the provinces. We have some harmonized tax which combine GST or federal portion plus the provincial portion all together. Now, this is the list of the provinces and territories which have a GST, which have PST, and which have HST. As you can see on the GST PST reality are 1, 2, 3, 4, 5 provinces and 1, 2, 3 territories. On the HST environment or reality are 1, 2, 3, 4, 5 provinces. So on the provinces level, 5 to 5. On the territories are not HST in the territories, only GST, 5%, as you can see. So which is the territory which don't charge PST? Obviously, all the territories, as you can see, Northern territories don't charge PST, Nunavut doesn't charge PST, and Yukon doesn't charge PST. On the province level, only Alberta doesn't charge PST. They don't like their citizens, that's why, residents, sorry, so that's why they don't charge them PST. All the other provinces, they like the residents, so they charge them 7% on the everything that they're spending. Not everything, but certain goods that they're spending. In Quebec, they like them even more. They charge them 9.97%. Combine those two, in some provinces in Saskatchewan make it to 11%, in Manitoba, British Columbia make it to 12%. Now combine HST, the lowest we have is 13, which is 1% higher than combined if we have combined in the British Columbia and Manitoba. The provinces that charging their citizen the most is New Brunswick, Newfoundland, Labrador, Nova Scotia, and Prince Edward Island, or all the Atlantic provinces. They are set on the 15% flat HST on everything, on the services and the goods. How are we going to deal with this? We're going to deal mostly with the goods and service taxes. I already have prepared your questions on the goods service taxes because I told you I want you to know this, the goods and service taxes. If you don't continue with accounting, I want you to know how to deal with the GST if you're running your corporation. First, every time when you're doing sales, you have to charge the GST. Every time when you're making purchases, you have to pay the GST because somebody's now when you're doing the sales, it's your obligation to charge GST to the client. Now, when you're purchasing, somebody else is doing the sales. But we already established that every time when somebody's doing sales, he has to charge the GST. And since you're the purchaser, now you have to pay it. Now, who's bearing the GST? The GST is buried by the final consumer, which final consumer most of the time is the individual. That's where the GST stops. So if company one sells something to company B, company one is going to charge GST, 10%, let's say $10 GST. If company two sell it to the individual, they're going to increase the GST. That means they're going to increase the sales price. That means the client, the final consumer, is never going to get on the first original price. Always have to pay the premium, which more GST, which doesn't make us feel any good, does it? But anyway, that's how we're paying the GST. And since we're the final consumer, we're paying the most GST. So again, we're going to keep track of two things: GST charge on the sales and GST paid on the purchases. This GST charge on the sales is the current liability. GST charge on paid on the purchases is current asset. GST charge on sales is called GST payable. GST paid on the purchases is called GST recoverable. Also is called input tax credit. So you have to, if you have to fill by yourself the GST tax return, you have to file it here as a input tax credit. Which amount you have to submit to the government? Well, the difference between payable and recoverable. Now, the example here was the business operates in the province without PST, just to make it for the example with the GST and GST effect only. They purchase sound system and pay GST. They paid advertising and again pay the GST, and then sell the service and collect $200 GST. So what's happened in the first one? They pay cash for the equipment plus the GST. They pay cash for the advertising expenses plus the GST. At this point, they need government to recover to them $125. Unfortunately, they make the sales, or maybe fortunate for them, they make the sales, and the sales naturally has to be above the cost if they want to make profit. So since the sales is more than the cost, and we're charging the GST on the sales, means our GST payable always going to be more than the GST recoverable. Once we do this, we're going to check what's happening in the GST payable. In the GST payable, we have $200. In the GST recoverable from the government has to recover us $125. So in reality, we have to pay to the government $75. Well, let's pay them. Close the GST payable with 200, close the GST recoverable 125, debit on the GST payable, credit on the GST recoverable, and fill the gap with the credit cash. Why? Because credit cash means your cash going down or you're paying cash. That's what the GST. Harmonized taxes, same idea, but we're working with a higher percentage, 13%. And the example here, as you can see, is same idea, but instead of 5%, we're moving up to 13% in Ontario. And at the end of the day, somebody has to pay the difference. Who will be that? Well, the one who collecting GST. So the company collect 520 GST, now have to pay to the government. So debit uh, HST payable, but the government have to pay back to the company $325. So credit GST, HST recoverable. Difference is 195. You have to send to the province of Ontario. Provincial taxes, again, provincial taxes are taught or those are called to be buried by the business. So those are non-recoverable and not recoverable is the business has to pay it, and those will be added directly to the expenses. If, however, we charge PST, we have to submit it to the government. The next short-term liability is the current portion of the long-term liability. Every long-term liability which is paid within the period of times gonna have the current portion and the long-term portion. Current portion always gonna be due within 1 year. As of today, up to 1 year, how much do you have to pay on your long-term loan? If there's amount, that will be current portion of the long-term debt. If there's no amount, nothing to show. So the current portion of the long-term debt, you can actually move it from the long-term into the current portion with the long-term debt. Now, accrue expenses, those expenses which we haven't paid yet, but we owe money, or we anticipated to owe money. Which one are those? Examples will be the interest payable, the one that we saw on the short-term note payable, property tax payable, salaries payable, and payroll liabilities payable. The other section of the current liability is unearned revenue. Unearned revenue is liability because until we provide the goods and the services to the clients, everything that the client pay for is a liability of the company to the client. So if the client already paid the cash, but he did not receive the service or the goods, the company has obligation to pay those one back. That's how the unearned revenue is created, and that's why the unearned revenue is recorded as a current liability. Examples will be the gift cards, concert tickets, airline tickets. For the unearned revenue, again, first we collect the cash. Second is when we period pass, if it's service, once the period pass, and once we earn the revenue, we have to show that revenue as earned. So unearned revenue, debit, credit will be subscription revenue in this case. Customer deposit payable is another short-term liability, which is related to the payment that we already receive from our customers. Company offer require that cash deposit as a security. So what's going to happen? Obviously, the company must return the cash to the customer under certain conditions. If we cannot fulfill the order, we have to return the cash. Let's see how we're going to estimate some of the current liabilities. Some of the current liability has to be estimated. That will be warranty payable, vacation payable, income tax, and contingent liabilities. For the warranty payable, I can clearly tell you even right now that there will be a question on the midterm, and probably I'm gonna go for the even in the final exam, which is gonna come from the warranty. I like warranties. It's easy for you to make a mistake, so it's examinable. What's interesting with the warranty? Warranty, it comes with the cells. It's attached to the cells. If there's no cells, there's no warranty. Because of that, the warranty has to be recorded at the period and at the time of the sales. If the sales are related to the current year, warranty expense has to be related to the current year as well. So what's going to happen at the time when we actually pay for the warranty or we have to replace the item which client doesn't like? That will be not recorded as expense for the company, but that's going to reduce the warranty liability that we have already created. So let's see how it's going to work. First, we're going to do the sales. And since we're not collecting the cash, we're going to create a debit accounts receivables. Then we're going to match the sales with the warranty expenses or opposite warranty expenses with the sales. So we're going to record the warranty expenses and we're going to show the warranty liability or warranty estimated warranty payable, which is going to stay as a current liability as a provision for the future claims from the customers for which we have to actually spend money. Let's pretend that the customer came and we had to do some replacement. For which replacement we're going to pay cash to our employees or anything like that. So for the money that we pay cash, we're going to deduct it from the cash account, but we're not going to create a new warranty expense. We're going to deduct the estimated warranty payable. Same thing we're going to do if we have to replace the item. We're going to reduce the estimated warranty payable and we're going to reduce the inventory for the items that we have to give to the clients as a replacement. Vacation is another short-term liability which require estimation. And that will be the vacation date which company owes to the employee. The journal entry will be every time when the employee earned the vacation. It's going to be vacation pay expenses, estimated vacation pay liability. Every time when the employee decided to take vacation, the amount of day times the rate of the employee, we're going to deduct it from estimated vacation payable liability. If the portion of the salary expenses, we're going to show it. And the credit's going to go to the cash account. We have to pay our employee cash. Income tax payable every time when the company, once the company, you're going to see this in tax courses for those of you who are going to continue with accounting. Once the company declare income, has to pay taxes. After that, every corporation in Canada, regardless public or private, they are required to pay at least the same amount of taxes which they paid the last year as installments during the year. So this company have to make installments every month of $100,000 over the year. They make those installments every year by debiting income tax expense and credit cash. At the end of the year, they already have income tax expenses 1.2 million and they pay cash 1.2 million. Now, at the end of the year, when they calculate the taxes, turn out that the actual taxes that they have to pay is not 1.2 million, it's 1,240,000. 1,240,000. So we have 40,000 difference, means we haven't paid that amount yet. So we have to show it as a income tax expense, and we're going to show it with the income tax liability, and then we're going to pay it within the period that has to be paid. The next section is contingent liability. Contingent liability is the estimation of probability of the future event. Contingent losses is the one who are recorded. Contingent gain are not recorded until they're actually realized. And we have a different scenario here. First scenario is how likely is this estimation or future lawsuit liability. If it's likely and the amount can be easily estimated, then we have to record it according to the accounting standard for the private enterprises. If we can define that the lawsuit against us is likely, but we cannot reasonably estimate the amount that we have to pay, in that case, we have to just not disclose it in the notes. Let's see the other one, which is unlikely. Now, if we have a potential liability, which is unlikely, but can be measured, and the loss can be significant, then we have to put it as a note on the note disclosure. But if it's not significant and unlikely, then no disclosure is required. If we cannot determine the level of certainty, then we have to disclose it on the notes financial statements. Ethical issue that comes from this contingency liability is on which interest, what's the interest that we are protecting when we're doing those journal entries. The other thing is, do we have enough information to disclose or too much information to disclose? So we have to disclose the right amount. Now we're going to move to the payroll taxes, but before we start with the payroll taxes, I'll suggest you to have a short break and then start with the payroll amount. And let's go and do something about payroll. How to compute payroll. Payroll is the practical part of this course in this chapter. So that's why I'm going to spend a little bit more time on payroll. I believe each of you should know about payroll and what's in payroll, what is included, what is not included. Let's go now. Payroll. There are numerous ways for the employees to express the employee gross payroll. We can call it salary. We can call it wage. We can call it commission. We could call it piecework. We can call it bonus. We can call it benefits. Salary, what's salary? Salary means the lump sum which is paid over the specific period. Is it going to be annual? Is it going to be monthly? Is it going to be weekly? That depends on the contract. Wages is the specific rate which is paid for amount of time which employee works. Usually that amount of time is hour. Commission is something else which is paid to the employee based on the percentage of some variable. That variable is usually sales. Piecework. Piecework is, imagine if the employee, actually, if the employee is actually, let's say we're running we're a publisher, and our employees are book writers. Based on the pieces of work that we're gonna print and sell, that employee is gonna get paid by piece. Bonus is something that is paid above salary or wages or commission or piecework. Benefits is something that it's not paid cash, but the employee get it as an extra on top of the salary, wages, commission. Example, the benefits can be the employee can get a free parking space in downtown. Now, the employee doesn't get cash, but has the benefits to park on the parking spot and doesn't have to pay. That's pure benefit. The other benefit can be employee when they sign the contract with the company, when become employee is given a company cell phone, which the employee can use unlimited. That's also benefit. The employee is not going to see cash, but the usage of the cell phone is in pure benefit for the employee. The other benefit can be third-party insurance, for which employee doesn't have to pay. Again, the employee is not going to get cash, but it has the benefits to use something for which it doesn't have to pay. So let's keep going with this and see how we're going to account for the payroll. We're going to have two measures for the gross pay. One will be the standard pay time, which is based on the employee salary or employee rate. And then we're going to have overtime, which is additional work which is required by the employee to work for the employer. Now, what's the overtime and what's the strike time? You can easily see it on internet and what is explained there about the regular time and the overtime. The only thing that you have to do is go to some searching engine. And once you open the searching engine, you can easily type PC Employment Standard Act. Once you get the PC Employment Standard Act, you can click here on the first one. Let's see if this is gonna happen. Effective. I'm looking for something like a PDF. Let's see if that's gonna open it. No. PC Employment Standard Act PDF. They should go. This one should work. And it's gonna open something like this. That's what you're looking for. PC Employment Standard Act. One thing that you should see is this act is current to January 27, 2026. So everything that is here is current. And you can see different content about the definitions, purpose of this act, hiring employees, then wages. And you're going to see the employer required to pay minimum wage. What's the minimum wage? What's the annual adjustment of minimum wage, pay days, how the employment is terminated, deductions, assignments, everything. Wages statements, payroll records, hours of work and overtime. That's which dealing with the hours. And here you can see is repealed, meal breaks, do we have the meal breaks? Meal breaks. Employer must ensure that no employee work more than 5 consecutive hours without a meal break, and that each meal break lasts at least half an hour. An employer who requires employee to work or be available work during the meal break must count the meal break as a time worked by the employee. And then you have the split shifts, minimum day works, minimum daily hours, maximum hours of work before overtime applying. And here says an employer must pay the employee overtime wage in accordance with the section 40, which we're going to see later, if the employer require or directly or indirectly allow the employee to work more than 8 hours a day or 40 hours a week. So I may require for you to stay 9 hours today, but if that doesn't transfer over 40 hours a week, you're not going to get overtime. Subsection 1 does not apply for the purpose employee who is working under the averaging agreement under section 37. So section 37, we're going to see which is the average agreement. If you're interested, take a look. Now, the interesting here was section 40. And section 40 is right here, overtime wages for the employee not working under the average agreement. Employer must pay employee who works over 8 hours a day and is not working on the average agreement under section 37. So this is the section that explains if you one day you work more than 8 hours, not combined for the week 40 hours. And 1.5 times the employee regular wage for the time over 8 hours, and double the employee regular wage for any time over 12 hours. Employer must pay the employee who work over 40 hours a week and is not working under the average agreement in section 37, 1.5 times of the employer regular wage for more than 40 hours. Now, as you can see, this one doesn't continue and doesn't say that if you reach over certain amount of time when the double rate applies. That's the interesting part here. If you're on the single day, once you reach 12 hours, anytime above 12 hours is double. But on the combined, on the 40 hours week, if you can having more than 40 hours per week, then that doesn't show, there's no double time here. Only hour and a half. And then you have banking of overtime wages, how this is gonna work, and all this related to the overtime. If you are interested, familiarize yourself. If you're working in the PC, you should know how this apply. And then you have the statutory holidays, how the statutory holidays is. So here the statutory holiday pay, an employee who is given a day off on the statutory holiday or given a day off instead of the statutory holiday under section 48 must be paid an amount equal to at least an average day pay determined by the formula. Amount paid divided by the day at work. Where explanation amount paid is the amount paid or payable to the employee for work that is been done during the and wage that's earned within 30 calendar days prior preceding statutory holiday, including vacation pay that is paid or payable for any day on vacation taken within the period, less than any amount payable or payable overtime. Day work is the number of the day of the days that the employee work or earn wages within the 30 calendar day period. So basically what this says is, if your starting date of employment was, let's say, is let's go with a real example. You're starting work on February 2nd, today, Monday. Now, February 16 is the statutory holiday. The way I see it, the way they're reading the act, now the employer has two options here. Either is going to pay you full wage for the family day on 16, either is going to apply PC Employment Standard Act. Based on the PC Employment Standard Act, since you work only 10 days before the start holidays, he is going to accumulate the amount payable, paid or payable, for those 10 days, divided by 10, and that will be the amount must be paid, employee must be paid statutory given instead statutory must be paid to amount equal to at least average day pay determined by the formula, and that will be your average day pay that's going to come. Amount that you paid for the 10 days divided by 10, and that's how much you're going to get. So that with the Business Employment Standard Act is a very interesting reading if you want, and I strongly encourage you to go over, spend some time and familiarize yourself for the payroll purposes. Now let's go back to our slides and continue with our slides. So now we know what the straight pay time is, or regular time, or an overtime. Overtime is 1.1.5 or 1.5 of the straight or the regular hour. Call time and a half. Now employee earns, so in our example, employee earns $20 per hour for 40 hours, and the employee work in total 42 hours. So what that means, the employee is going to be paid $20 for the 40 hours, and for the 2 hours which work overtime, he's going to pay 1.5, which is $30 per hour. So in total, the gross pay for the employee will be $860. Now we have to go to the point that what means gross, what means net. Simply how you can picture it is the gross is the amount that you want, you earned, you want, you like, but you're never gonna get. Then what's the net amount? The net amount is less than the gross amount. That means that amount you're not gonna like, you don't want to get, but the only one that you're gonna get. Why? Because what's the difference between what's happened with from the gross to become net? There are deductions. What kind of deductions? Taxes, Canada Pension Plan, employment insurances, and any other applicable deductions. So the gross pay is the total amount of the income, which is going to go to your income for the income tax purposes before paying anything. And the net amount is the amount that you're going to get as a deposit to your bank account, which will be minus all the deductions that the employer has to take from you. Deductions. Those are deducted directly from the employer. It's not like you work, this doesn't work like this. You work 42 hours, I owe you 860. So I'm giving you 860, and then you have to start paying me for the taxes and for this and for that. That doesn't work that way. So how it works? The employer calculate how much you work and the money that you earn. That's your gross starting point. That will be your income. Then the employer is required by the Canada Revenue to deduct first for the statutory deductions, which include income tax, Canada Pension Plan, or Quebec Pension Plan, depends on the province, employment insurance premium, and this amount obviously can be deducted using the online calculator, which is provided by Canada Revenue. I'm going to show you that calculator in a few minutes. Those are the statutory deductions. Plus, employer can do some optional deductions, which may be registered pension plans or registered retirement saving plans. Next one is union dues, insurance premiums, and charitable donations and any other if requested by the employee. That's the deductions that the employer takes from the employee. Now the question is, what's the cost for the employer to pay the employee $860? The cost is that the employer has to match deductions that is taken from the employee for Canada Pension Plan. Also, employer has to pay employment insurance premium, but 1.4 time employee contribution. Plus, employer has to pay worker compensation plan premium. And from 2020 or maybe a little bit early, the employer also has to pay BC employment health taxes. So what that means is once you're not international student, once you get this post-graduation working permit, or if you're already working, if you're a resident, then you don't have to pay BC health. Who paying it? Employer pays it. That cost was shifted from the workers to the employer. So how this gonna work? The employee get the gross pay $1,500. That's the gross. The employee earn $1,500. Now the question is, how much employee is gonna get? Employee is gonna get $1,132.47. Why? Because the employer has to deduct income taxes for the federal government, income taxes for the provincial government, Canada Pension Plan for the Canadian government, and employment insurance for the government. When you combine all those deductions plus the net pay for the employee, it's going to give you $1,500. Now the question is there anything else that the employer has to pay? Yes, there is. What is that? Employer, on top of $1,500, he also have to pay Canada Pension Plan in the amount that the employee pays door to door, plus employment insurance to the amount that the employee paid time 1.4. Now let's run the calculation. I don't know which year is this. That's probably 2025. But let's make this one practical and let's see how much the employer has to pay today in 2026. So how are we going to do this? Again, let's open, I'm going to go back to the BC Employment Standard Act screen. And from here, I'm gonna open a new searching engine and I'm gonna go with Canada service revenue service, payroll calculator. And then you're gonna see this online calculator. Once you click on the online calculator, you're gonna see this. I'm gonna copy this link. If you cannot find it, I'm gonna post it for you in the chat room so you can see it in the chat room. So let me make it to everybody. Can you guys see the link? You should be able to see the link in the chat room. The link for BC Employment Standard Act is right here. Let me post you that one too. And you're going to have the both links in the chat room. So let's go to this payroll deduction calculator and start working there. Scroll down and when it says accept. Accept it, I accept it. And then it's going to open a new page, which we're going to start online calculator. We're going to pay this person, imaginary person, we're going to pay salary. And we're going to click next. Employee name, that's not important. Employer name also not so important. Now the province is important because that's going to determine the federal taxes. Pay period frequency is also important because that's going to give you different types of employment that we have. And as you can see, options that we have here are a lot. What that means, so I can pay the employee daily, which means I have to pay him 240 pay periods per year. I can pay him weekly, which is 52 pay periods. I can pay the employee bi-weekly. I can pay the employee semi-monthly. I can pay the employee monthly. Or I can pay 10 periods per year, 13 periods per year, 22 periods per year, weekly with 53 pay periods, or bi-weekly with 27 pay periods a year. So let's choose bi-weekly with 26 pay periods. And let's say that the next pay for the employee is going to be February 13. So not this Friday, next Friday. And let's keep going. We're going to go to the next page and let's put the wage that we have as example, $1,500. There's no bonus payments, no vacation pay, nothing. We're going to keep it simple. No taxable benefits allowances, no deduction for those, nothing. We're not going to deduct from the employee RSP or pension plan or union dues or annual deductions, anything like that, nothing. And we're going to click next. Then we're going to keep the basic amounts from the TD1 form from Canada Revenue for the this is for the federal, this is for the provincial. We're going to keep the same maximums. We're not going to change the maximums. We're going to keep the number of the pensionable months 12. And we're going to see, and the employment insurance calculated based on 1.4 for the employment. Sorry, for the employer. And let's hit calculate and see what we're going to get. So if we our employee earned $1,500 for the last 2 weeks, which we have to pay on February 13th. We have to deduct from $1,500. We have to deduct in total $139.50, which they're gonna go $98.53 for the federal tax, $40.62 for the provincial tax. Also, we have to deduct for Canada Pension Plan $81.24 and from the employment insurance $24.45. In total, we have to deduct from the $1,500. We have to deduct from the employee $244.84. In total, we have to pay the employee $1,255.16. So 1,500 minus 244, which we have to pay to the government. Now it's the employer responsibility to transfer those money to Canada Revenue. And we're gonna make a deposit to the employee bank account for 1,255.60. Is that over? No, it's not. What we have to do next is keep going and say employer remittance summary. And let's see what's going to happen. Employer remittance summary. Employer remittance, how much money the employer has to send to the government. The employer has to send to the government $81.24, the money that he gets from the employee. Plus, employer has to add another $81.24 from himself to match the Canada Pension Plan contribution from the employee. In total, the employer has to pay $162.48 for Canada Pension Plan. Plus, employer has to pay $24.45, which he deducts from the employee. Now he has to pay it for the government. Plus, employer has to pay $34.23, which is 1.4 of $24.45. In total, employer has to pay $58.68. Total deductions. So for this calculation, the employer has to submit to the government 360 and $31. So if you want to see combined results in PDF, we can start. Click here. Now that's going to transfer, that's going to ask me to save it somewhere. I'm going to save it on my desktop here. And I'm going to open it for you so you can see it. Let me stop this sharing and I can open you the new page, which was open for me here. Now, what we can see from here. From here, we can see that I can give this to my employee and explain that, yes, you earn $1,500, but you're going to get only $1,255.16. I'm going to keep $244.84, which I have to submit to the government. Make sense? Now, I as employer have to submit to the government $360.31. Why? Because I deduct from the employee $81.24 as a Canada Pension Plan. $81.24. Plus I'm adding $81 for myself. That's total $162.48. Then I'm take from the employee $24.45 as employment insurance. $24.45. Plus I added 1.4. That's $34.23. In total, I have to pay for the employment insurance $58.68. And the last thing that left is I took from the employee $139.50 from the income tax, which I have to pay for the government. 139.15. In total, I have to pay for the government 360.31. On top of, so no, sorry, that's not on the top, but that's how much I have to pay to the government. So now the question in this point is, for me as an employer, how much is my total cost? My total cost is $1,500 plus 81.24 plus 34.23. So that's $115.47. So my total deduction is my total cost to have this employee for $1,615.47. So now, how are we going to express this as a journal entries? Let's go now to our slides and let's take this one and do it as a journal entry. As you can see, this example is probably, it's not from 2026. That's no questions about it. It cannot be a 2026, but at least Canada Pension Plan and Employment Insurance are very close. Anyhow, let's go now for the journal entry. Payroll system. Before we go to the journal entry, let's see what the payroll system we're going to consist. Good business practice require paying employee accurately and on time. Payroll system can accomplish this goal. So if you don't have a currently running payroll system, you can easily use Canada Revenue online payroll calculator. As you can see from the calculator, you can print the pay stub for the employee, plus you can print the deduction sheet for use for the employer. Life is okay. Now, which are the component of the good payroll system? First one is the payroll register. We have a system which we're recording all the entries for the earnings, deductions, and everything. Payroll checks, the one that we just saw, and employee earning records. Employee earning records will be a different section, and that will be accumulated month after month to say the current month what the earning is, total to date how much the earning is. Let's go with the payroll register. Payroll register, that's a special journal which is used to organize the whole the payroll data. It's going to have a list of the payroll data for each employee. Services, that will serve as a check register. And that's going to provide the information for the recording of the payroll expenses and the related withholdings. In that case, payroll register, we're going to have that. So what will be the example? Example is going to look like this. Again, as you can see, is not something new for you. Let's make it bigger so you can see it. It's from Excel spreadsheet. So on the Excel spreadsheet, what you're going to have? Different columns. For first one will be payroll period with which payroll period ending. Then you're going to have column here, employee name. Next one is the hours that the employee work. How much is the, now if I word these people, what I'm going to do here is hours worked, hourly wage, and then I'm going to start based on the hourly wage. You're going to have the regular time or straight time and overtime. Right now, you can easily guess what's the hourly wage for the first employee. 620 divided by 40, you're going to get the hourly wage. Right? If these employees pay $1.50, $90, if the $1.50, $90 a $1.50 of something, you can easily come up with how much is the average, so how much is the regular wage for this employee. Then we're going to the total. Regular time plus the overtime. Now, if you want to make this practical, you have to have working hours. Then you're going to have statutory holidays. Then you're going to have sick days. Then you're going to have, you may have professional development days. Then you're going to have vacation days. And then you're going to have overtime. And you're going to start putting hours. Then you're going to start running calculation. And the total amount for each employee you already set here. Now, based on the total amount, we start deducting taxes. Not exactly like this, but let's keep it simple. Based on this amount, we just start deducting taxes. In reality, if you want to get the total taxes correctly, what you have to do is get the total amount for the month, time it by 12, or let's say this employee is paid 26 pay periods. Time it by 26. You're going to see the total amount. As you know, in Canada, we're paying taxes based on the progressive rates. Means more income you're making, more taxes you have to pay. So the question is, based on the amount that you're earning this pay period, how much will be the total income and how much, in which tax bracket you're gonna be? Based on the tax bracket that you are, that's how we're gonna calculate the taxes. That's the calculation behind the calculating the taxes. Once you get that amount for the federal and provincial, then based on the current earnings, then we're gonna calculate Canada Pension Plan. Usually, that percentage is given from the Canada Revenue website. You can easily see it. Employment insurance, again, is based on the Canada Revenue website. Again, the percentage is known. Here, the other thing that they're doing is they're deducting for charitable donation in United Way, $2 for those 2 employees. Then calculating the total deductions for the employee and the gross minus deductions, it's going to give you the amount that has to be paid to the employee. Next thing that we're going to see is the number of the check that was issued for that amount. And then we're going to start debiting accounts. This is for the office, this is for the sales, this is for the office, this is for something else. And we keep going until we're getting everything, which department the employee belongs to. That's your payroll register, which tells you all the information in one place. Then we're going to get to the paycheck. On the paycheck, now, we're not giving the check to the employees for this amount anymore. That is generating from the system, and this money goes directly to their bank account. And this pay, basically, yes, it serves as a paycheck, but it's more like a pay stub. On that pay stub, you're going to see from where the total comes from. Straight time plus overtime this. How much for federal taxes, provincial taxes, Canada Pension Plan, employment, deduction for the charity, total deductions. What's the net pay? So that will be the gross minus the total deductions, going to be the net pay. And which check is the one that's serving for that pay? Now, what here is missing is that's kind of partially a payroll stub, But on this one, it has to be, again, you have to show the employee as hours, as a dollar amount, as a current earnings and total earnings, current deductions, total deductions, and then the net pay. Now, let's go to the next slide, payroll entries. Now we have to, once we have the payroll stuff, payroll information from payroll register and payroll checks, now we have to prepare the payroll entry. Let's pretend that details for the payroll register show the accrual for the weekly payroll for December 31st, 13,654. That amount for the gross office salary and that one for the gross self salaries. The takeout home pay is 9,863.34. Let's see if that's the one. Yes, that's the one. So basically, what they're saying is office salary making 4,464, self salary making 9,190. Total deductions, as you can see, is 3,790.68. Out of those deductions, sorry, that's total pay. Total deduction 3,790.68. So out of those deductions for federal taxes, we have to submit 1,966.18. For provincial tax, we have to submit 892.72. For Canada pension plan, we have to submit this one plus the same amount from the employer. For the employment insurance, we have to submit this amount plus 1.4 this amount. And to United Way, we have to submit this amount. So as a direct deposit for the employee, they're gonna get 9,863.32. As you can see, here as a direct deposit, they're gonna get 9,863.34. Now there are three entries which are required. First entry is to record the accrued pay for the wages, salaries, and bonuses. So let's get this one. One option is we to see the slides. The other option is to do it together on the Excel spreadsheet. Which one you want?
How about
Slides?
Excel?
Okay. For the Excel, I'm going to copy this and I'm going to move to the Excel spreadsheet. And I'm going to share my Excel spreadsheet with you. And I'm going to copy this information, which I will just get. This is our information. That's from where we're getting the information. So I'm going to make those cells bigger. Let's go with 18. I'm going to make them dollar amount. What else? Everything to be in the middle at this point. Now let's see how this works. Okay, first thing first. We're going to start. The slide says we have to do three types of entries. First, to record the accrued payroll for the net wages, salaries, and bonuses. Let's do that. Let's record those one. First, we have office salary expense. You can see it. Office, debit, office, salary, expenses. And then we have debit, sales, salaries, expenses. Let's make it the same. Boom, done. Those two are done. Now I can make this one. And I'm gonna leave another one here for the, actually I'm gonna move this one. That will be my credit. Credit, gonna open it, and then this will be the amount for debit and amount for credit. So I'm gonna debit here, and that will be my credit here. I'm gonna debit 4464 for the office salary and 919000 for the sales salaries. So in total, remember, total has to be debit and credit has to match. So let's see where is our total here. My total is 13,654. Now the same amount I have to get on the credit side as well. Otherwise I won't be in balance. Let's go now. Credit. Let's see which account now we're gonna credit. First, out of those money, what the employee is not gonna get. From the employee, we have to deduct federal income tax. So credit. Federal income tax payable, since we have to pay it. Next one will be credit provincial. Income tax payable. Next one will be Canada Pension Plan payable. That will be employee. Then we have to pay employment insurance, credit. Employment insurance payable. Again, employee. Next one will be United Way. That will be charitable donation. United Way. And that's about it. No, the last thing that we have to do is the cash. Let's pay them cash. Credit. Cash, which is means electronic fund transfer to employees. So let's go now. We again, the objective here is to have the same amount. It's not gonna give me that, so let's get rid of this and let's put here 0. And then I'm gonna get all those one. My objective is to get here the same amount. Or I can go simply with this. Gonna be the same. So let's say federal income tax, I have to pay the Canada revenue in total 1966.80. Plus I have to pay for the provincial 892.72. Also, I have to deduct from my employees 577.77, which I have to pay for the Canada pension plan. Plus I have to deduct from my employees 199.01 for the employment insurance. Plus I have to deduct from my employee 155 for the charitable donation, and I have to pay. So now the total deductions here, as you can see, are exactly matching the amount of the total deductions here. And the last thing that left is to make a e-transfer in form of checks to my employee for 9963.34. Once I do that, I have match between debit and credit, so I'm in perfect. That's entry number 1. Now we have to do the entry number 2. Entry number 2 will be related to employer deductions. This is the uh, employer expenses and employee deductions and payment. Now let's see what the employer has to pay. Now, what I'm gonna do is probably I'm gonna copy this and I'm gonna paste it here. It doesn't let me. So let's try again. Copy this and paste it here. So this one will disappear. I don't need this. I don't need this. I don't need all those. Let me see what else says on the slides on the employer deduction. Is there anything interesting on the employer deduction part? No. So let's go to the employer deduction. First, employer, as we said, he has to match Canada pension plan that was taken from the employee. Now, that for the employer will be employee benefit expenses because he has to pay this because he has the employee. That's not going to be the salary expenses anymore. It's going to be employee benefit expenses, debit. Expenses. Now we have to see what will be the total here. There will be no other debits, only one debit here. Next thing. The employer has to match, as we said, Canada Pension Plan. Canada Pension Plan expenses, but that will be employer. And that amount has to be exactly equal to the Canada Pension Plan, which taken from the employee. Now, the next thing that we have to do is I'm just going to copy it like this. Employment insurance payable, but that will be employer, not employee. And that will be what the employee paid, what we deducted from the employee. Yeah, the employee paid, we deducted and paid to the government, time 1.4. So in total, the employee benefits to have 13,654 payroll is 856.38. So that will be the amount that we're gonna debit here, 856.38. Now we in balance. The entry is completed. That's entry number 2.
Can you post this?
Yes. So again, this is Canada Pension Plan 1.1.2.1. Canada Employment Insurance is 1 to 1.4. The third entry, now we have to clear all those payables. Make sense? Because the Canada Revenue is going to start saying, hey, where are my money? You get my money from the employee. Now give it back to me. And then we have to do the third entry, which is going to be, again, I'm going to copy this. And I'm going to post it here, V. And that will be number 3. And now we start changing everything here. First thing first, I'm going to debit. Let's start paying first federal income tax payable. Let me grab it from here and paste it here. Federal income tax payable. Second one, we're going to pay the provincial income tax payable. Next one, we're gonna pay Canada Pension Plan employee portion. And then we're gonna pay the Canada Pension Plan employer portion. Then we're gonna pay employment insurance employee portion. And then we're gonna pay employee portion, employment insurance employer portion. Last thing that left is to pay for charitable donation United Way. This is also payable United Way. That will be payable at the end. Just to make it clear that this one is payable. And we're gonna credit one account only, that will be cash. Because all those people, they want their cash. So let's see how much we have to pay. We're gonna clear the federal income tax that we took from the employee, we're gonna pay it to the government. The provincial tax we took from the employee, we're gonna pay it for the government. Then we're gonna pay Canada Pension Plan, which we take from the employee. Plus, we're gonna pay the Canada Pension Plan, which we accrue as a employee benefit expense. Then we're gonna pay for the employment insurance that we took from the employee. Then we pay the employer portion of the employment insurance, which is employer benefits. And the last thing that left is to pay the charitable donation which we took from the employee. And we're gonna pay everything with cash. And we're done. And that's how you're doing the journal entry for the payroll that you may have in your company. Remember, the first thing is the what you're paying from payroll. Second thing is to show the portion which is related to the employer as employee benefit expenses. And the last thing is to clear all the payables by simply creating cash.
Quick question.
Yes.
Would the ratio always be 1 to 1.4 for the EI payable employer?
In reality, yes. Also in reality, there's exemption. And
Okay.
those exemptions are for the company which have a certain class of healthy provision which are required to give to employee. For example, there are some employee which working with uh, material which is not healthy for the employee. For that reason, they have to provide some extra benefit for the employee to cover those materials which are harmful for the employee. For that reason, they're allowed to take deduction of that rate 1.4. That can go to 1 for some companies. But again, to see which companies are those, we have to work case by case. Most of the company, majority, let's say 90% of the company in Canada, they paying 1.4. But on there's again specific companies which dealing with something which is harmful for the employee and providing extra benefits to overcome that harm, they might be allowed to get this rate to 1. But they have to apply for the employment insurance, Canada Employment Insurance. Once the Canada Employment Insurer approve it, they're gonna describe what's the ratio that they have to take. This is from the industry real stuff.
So just to recap, so like the more dangerous the work, the one-to-one is used, right?
It most likely, yes.
Oh, okay. Okay. Thank you.
So in order to check if I'm correct, what we can do is we can clearly simply go to the website, some website, online calculator. Let's go to this our calculation and let's see uh, employment insurance reduce rate 2026 program. Rates and premium reduction program for employers. General information. If you are employer who provides your employee with the short-term disability plan and your plan meets a certain requirement, you might be entitled to pay your employment insurance premium at rate that is lower than standard employer rate 1 to 4 times the employee employment insurance premium. Short-term disability plan registered with the premium production plan may have the elimination period before the payment or benefit similar to employment insurance waiving period. So basically, if you're getting that, how can a premium from somewhere else, you may get the deductions. Basic requirement must be met. You have to provide at least 15 weeks of benefits for the short-term disability. So the first 15 weeks, employment insurance doesn't cover, so you cover it through your insurance. Match or exceed the level of benefits provided under employment insurance, pay benefits to employee within 8 days of illness or injury, be accessible to employee within 3 months of hiring, and cover employee for 24 hours a day basis. And then you're going to have a program guidance, reduce rate, category. You have different categories. Category 1, 2, 3, 4, and the rates and the multipliers. So if you click here, you're going to see the multipliers. So as you can see, the multiplier is not 1.4, it can be lower. If your category 1, uh, cumulative paid sick leave plan, enhanced paid sick leave plan. If you're providing the weekly indemnity plan, that's with the rates. And if you're applying the special weekly indemnity plan, that's the rates. And that's how they go. So basically, very, very, I don't see any way one-to-one ratio. But again, if you want to apply, the company has to meet the certain requirements. Once those requirements are met, then it comes to that. But usually not all the company are providing this. Mostly the company, again, which have some specific kind of industry, specific kind of hazard issues. Those are the ones who providing those type of extra employment insurances to short-term disability to their employees, and they're allowed to those deductions. That was something extra for you. Let's go back to the slides and finish the slides now. So once we have this information here, we can easily go to the journal entry and start plugging the numbers. Again, don't forget, total on the debit has to match the total on the credit. For the payroll that the employer has to have to pay is treated as a employee benefit expenses, and thus that's related to kind of the pension plan payable on the employer, employment insurance payable for the employer. And the next thing will be now here in this case, Those go to salary payable. In our example, we just pay them cash right here. In this case, here we're paying the cash. And the last entry is we to pay for the Canada Revenue Employment Income Tax, federal and provincial, Canada Pension Plan payable for the employer and employee, employment insurance payable for the employer and employee, cash, and the United Way, the cash. And we're done. Now, employee payroll records, the worksheet of each individual employee providing the details for the year-to-date earnings and withholding. So you have two requirements, one to show the current and one to show year-to-date earnings and withholdings. Why do we need those? Because those accumulations after that are used to prepare a T4 slip for the employee at the end of the year. That year-to-date records helps us to prepare the T4. Now the T4, the requirements is one T4 has to be sent to the employee by February 28th. And by the same date, February 28th, one slip has to be filed to Canada Revenue. What that means to you? Means that Canada Revenue most likely knows how much you earn. So if you receive T4 from the employer, make sure you're reporting that one as an income because Canada Revenue definitely has it. Now, you may have another situation which sometimes happen. Canada Revenue may have the T4 from the employer, but you don't have it. What that means? That means it doesn't mean that you don't have to record that income. In the contrary, you have to record that income even if you don't have the T4 slip. How can you record it? Very simple. Go to your Canada Revenue account, check what kind of T4 slips Canada Revenue has, which you don't have, and make sure you include it in your tax return. Again, employers are required to send the Canada Revenue all the information regarding your T4. Same thing with all the financial and non-financial institutions which dealing with your investments. That will be T5. They are required by law to file all the information to Canada Revenue. The fact that you don't have those slips, it doesn't change the fact that you have to report those one as an income. Because if you don't, you're gonna get a nice letter from Canada Revenue for the income that you miss, plus the penalty, plus the interest that you might have to pay. So be careful with that. Independent contractors, how are we gonna deal with the independent contractors? Usually, Canada Revenue doesn't like the independent contractors. Why? Because they technically losing money. What that means? That means that if we pay independent contractors, we pay based on the invoice. So we don't have to deduct payroll deductions. And that doesn't create payroll cost for the company. But again, Canada Revenue doesn't like it. Why? Because they don't get their money. They have to wait till the end of the year, that independent contractor to submit his income, and then he gets the income taxes.
Quick
Yes, Roman.
question.
Yes.
Like this is also applies to like people who live in the United States, but like indirectly like through remote work or other means work with a Canadian employer, for example, right?
Those probably have employment connection or have employment
Because like
contracts
yeah,
with.
because like yeah, they're earning Canadian income even though they don't live in Canada, but like they live somewhere else across the globe. I've seen
Don't
that
worry, don't
happen.
worry. There are special instances for that one.
But I was just
But
wondering if the independent contractors refers to that situation.
it might be. But
Oh, it
anyway,
might be.
people who are not employee to the company and are hired by the company to provide certain services, those are the independent contractors. Again,
Okay,
the independent contractors is not employee for the company. They
okay,
con For that reason they have a contract for certain work. When that work is done, they are not they're done. They're paid and it's over. So during the time of the contract, they're they're not allowed to use any company assets. So they have to provide their own assets. They have
okay,
to pay their own insurance. They have to pay their own expenses and everything. So
okay.
technically, the risks, all the risk for the job completion, it depends on the contractor, not on the employer. For
I
that
was
reason, they're just paid. Deductions, no deductions are withheld, and that's pure expense for the company.
Okay, I was kind of wondering whether this particular scenario would apply as a independent contractor. Say like, like in Canada, we have two official languages, English and French. Say like someone in France wanted to write a comic book or something like that and like sell it to Canadians. Uh, would they be considered independent contractors if they find a means of how to go about doing that?
Who is the employer? Who pays the money?
It could be Amazon, it could be another international company where like, I've heard of people like, who want to, get employed by a company in Switzerland and they're kind of considered like, like it's against the EU law to hire someone that like, who has no European Union background or is not from
Yeah, yeah, yeah,
Europe
yeah, yeah,
originally.
yeah,
So I
yeah.
was one, my question is kind of connected to that, except we live in Canada. How would they, for example, if like I've seen
You know,
independent
your
contractors
question
like,
your question is not accounting question. You know that, right? You're not
okay,
asking me you're not asking me financial reporting accounting question. You're asking me tax question here.
oh, okay, so I would learn about that in the tax.
Correct. Yes, that will be the international taxes.
Oh, okay.
That will
Okay.
be the national taxes. You can hire somebody from outside, which is not a Canadian resident, and when you pay him, you have to withhold certain amount of taxes. So if the contract is for $10,000, you're not paying him $10,000. You're paying him 10,000 minus the required taxes that you have to withhold. That's one option. The other option is that person, if he's Canadian, you just treat him as a contractor, and then he's responsible for his deductions.
Okay,
And
so this is a higher level accounting question, like income
it's not.
tax and so
It's
on.
again, it's not accounting question. It's tax question.
Oh,
There's no financial reporting for those one. For those, the reporting is their expenses for the company,
oh, okay.
right?
Okay, that's interesting to know. Thank you.
So, how are we going to report this current liability on the balance sheet? That's with the payroll. Payroll we done. So let's go with the current liability. As you can see, the current liability are listed. Uh, that's the example. Now, again, when you see the question like this, see what the question requires. Listed by the biggest to the smallest amount or listed based on the liquidity, but then they have to give you some example. So in this case, you can see accounts payable, salaries payable, estimated warranty payable, current portion long-term payable, GST payable, interest payable, and all those different payables until you get the total current liabilities, then showing the long-term liability, and then you combine the total liability. Calculation for the total current liability, calculation for the total long-term liability if you have more than one item. If you have only one item, you're just showing the total long-term liability without cover with the online, but there will be no here on this site, there will be no calculation because the amount is the same. And then you got, in that case, might not even have to show the total. If it's one line long-term liability not payable, you may not have to even put the long-term, total long-term liability. It can be just long-term liability not payable, and then you show the total liability will be the current liability plus the not payable. This, the differences international financial reporting standards versus the accounting standard for the private enterprises, that lies on the probability and how the probability is treated, but and contingencies, that's under contingencies. But again, for those one, I'm gonna leave it for the people who's gonna continue with the accounting, and those specifically those one who's gonna deal with the intermediate financial reporting, which is 332, I believe. Those are the ones that are gonna see and deal with the liability from the international financial reporting standards point of view. And that concludes this liability part.